Hello there, welcome to the next video in this free bookkeeping course. Thank you so much for being here. If you've joined this series here, then please go and watch video 1, the previous video to this one. The videos are created for your benefit and go in order for your benefit. So go ahead and find video 1, then come back and watch this video. In the previous video, I gave an introduction to bookkeeping. I spoke about what a bookkeeper is, what an accountant is, why bookkeeping is important, and some other things. In this video, I'm going to explain some of the financial terms that are used in the accounting world, namely capital, assets, and liabilities. So I'm going to define those terms, explain those terms, and help you understand what they are. Now, there are lots more financial terms, accounting terms, bookkeeping terms in the world of bookkeeping, finance, and accounting. I will explain more terms as I need to as this series goes on. So there are lots more terms than covered in this video, but later on as this series progresses, then I'll explain other terms along the way. Hopefully that makes sense. So what is capital? You may have heard the term capital before in the sense of a capital city, but capital has its own term within the financial world. So what is capital? Capital, in the most basic, simple sense, is the money that, or the cash or the investment that the owner has put into a business, company, or organization. So let's say you were starting a business, and when you open your business account, obviously the balance is going to be zero, and you're going to need money to buy equipment, to buy stationery, to buy stock to resell, or whatever it is, a van to travel. There are lots of things you have to pay out for in the beginning. You're going to need money for that. So generally what happens is the owner, the person that started the business, will put money into the business bank account, and this is referred to capital. So some people will start a business with very little capital, say $200, £200, where others may invest £100,000, $100,000. So the amount of capital can vary greatly. It all depends on the amount of capital that's needed to start the business. Now, once again, in the most general and simple terms, capital can also be called equity. So you may have heard of equity, owner's equity. That, once again, in the most simple terms, is the money that owners have invested into their business. Now, any capital that's introduced, that's the terminology that's used, so capital introduced, any capital that's introduced into a business is owed back to that owner. And you'll learn more about this as this series goes on. Now, the photo that's showing on this slide is like a tug of war, someone pulling a rope. That's because capital can give a business power, can give a business leverage. If a business is struggling for cash, introducing capital can give the business the strength it needs to carry on trading. Hence why I've placed that photo, just in case you were wondering. What is an asset? So what is an asset? I'm sure you've heard this term before. What is an asset in a financial sense? An asset is something that the company, business, charity, organization owns. So something that the company owns. And there's this acronym PPE, which can help you understand assets a bit more. PPE, that's not personal protective equipment. This is actually plant, property, and equipment. So all those things are assets: plant, property, and equipment. So assets are something that the company owns. So if a business was to buy some machinery, that would be an asset, something that it owns. If the company was to buy a business vehicle, that would be an asset. If the business was to buy its own premises, that would be an asset, something that the business owns. Now, I've also put cash on the list because cash is also an asset. The company or business owns cash. So if you've got a positive bank balance, if the business has a positive bank balance, that's an asset. Also worth mentioning at this point, any money owed to the business is an asset. If someone owes the business $10,000, £10,000, 10,000 euros, whatever it is, that is an asset. Something you own, even though you physically don't have it, it's owed to you, you own it. It's money that you own. So that's what an asset is. And like I mentioned, if you've got questions about this, feel free to use the comments section below. So what is a liability? Well, a liability is the opposite to an asset. It's something that the company owes. So a couple of examples of this would be loans. If the business got out a bank loan, it owes that money back to the bank. If it has investors, it owes that money back to investors. Credit, so any suppliers that you have credit with, if there's a balance that you owe them, that is a liability. So assets and liabilities are opposites. Assets are what you own, liabilities are what you owe. So that's it for video 2. As mentioned earlier, if you go over to my website, freebookkeepingaccounting.com, you can just click on free stuff here. You can find the bookkeeping section, which is here, and just watch these videos that appear on this screen. Now, at this point, it's worth mentioning my ultimate bookkeeping course. If you're finding this course interesting, if you find it beneficial, then please consider the ultimate bookkeeping course that will teach you the basics of bookkeeping and accounting, but much more extensively. So not necessarily more advanced, it's still sticking with the basics, but it has lots more examples, it has little assignments that you can complete. It just helps that learning process so much better. So you can go and click there at the center of the screen up here and learn more about that. Okay, thank you so much for watching this video. I will speak to you in video 3 when we start looking at double entry bookkeeping.